Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CHIMERA Investment Corporation quarterly report. CHIMERA Investment Corporation offers a diverse range of businesses and services through its two main segments, investment portfolio and residential origination. The company invests in various types of mortgage assets, including residential mortgage loans, non-agency mortgage-backed securities, agency mortgage-backed securities, business purpose loans, investor loans, and mortgage servicing rights. In addition to investing in mortgage assets, CHIMERA also offers third-party advisory services. This suggests that the company has expertise in real estate-related matters and can provide valuable guidance to clients seeking advice on investment opportunities or other related issues. As a real estate investment trust, REIT, CHIMERA is required to distribute at least 90% of its taxable income as dividends to shareholders, which indicates that the company's primary focus is on generating returns for its investors. Overall, CHIMERA Investment Corporation provides a range of services and products related to real estate investment and mortgage financing. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors that impact a company's financial performance. On the revenue growth side, key contributors include net investment income and net realized gains on investments, which have consistently shown positive trends. Additionally, increases in net interest income, total other income, losses, and sales of non-agency securities have also contributed to revenue growth. Furthermore, securitization activity, monetized interest rate swaptions, exited short TBA positions, Palisades fee-based income, gain on origination and sale of loans, loan origination volume, premium from loan sales, and excess spread agreements with Fannie Mae loans have all played significant roles in driving revenue growth. On the other hand, revenue decline drivers include realized losses on sale of non-agency securities, net book value loss from redemption of securitized debt, transaction-related expenses, termination of interest rate caps, and declines in market value of agency MBS portfolios. These factors have resulted in significant losses for the company, impacting its overall financial performance. In terms of neutral or stable revenue drivers, interest rate lock commitments and TBAs have shown relatively stable trends, with minimal impact on revenue growth or decline. Overall, a comprehensive understanding of these drivers is essential to identifying areas of improvement and making informed decisions about future business strategies. Net income experienced a significant decline between 2025 and 2026. The decrease was substantial, with net income dropping by $211,207 from 2025 to 2026. This trend continued into the first quarter of 2026, where net income decreased by $72 million compared to the fourth quarter of 2025. The profit margins also underwent a change during this period. While the net interest income margin increased from 36.4% to 39.5%, the total other income margin saw a significant decline from 72.1% to -34.2%. This decrease in profit margins was largely due to a net loss in 2026 compared to a profit in 2025. The reasons behind these changes are multifaceted. An impairment charge related to the Palisades acquisition contributed to the decline in net income and profit margins. Additionally, factors such as widening spreads on mortgage loans and securitized assets, market value declines in agency MBS portfolios, interest rate mismatches, and changes in prepayment rates all played a role in the decrease in net income and profit margins. The company's financial performance indicates a consistent trend of generating positive operating cash flow. This is evident from multiple sources within the extracted summaries. On page 76, it is explicitly stated that the company is producing positive operating cash flow. Similarly, on pages 88 and 109, the same conclusion is drawn. Furthermore, page 121 confirms this assessment with a clear indication of positive operating cash flow. These findings collectively suggest that the company's operations are generating sufficient cash to cover its expenses, resulting in a positive operating cash flow. The company's debt level has experienced fluctuations over the period under review. On one hand, total debt increased from $13,235,848 to $13,541,000 $515,620, and by $956 million due to secured financing agreements. Additionally, total UPB increased by 157% from $342 million to $883 million. However, other pages indicate a decrease in debt level, such as a reduction of $1,217,174 in total liabilities. Interest expenses have also shown mixed trends. While some pages report an increase in interest expenses, others show a decrease or no significant change. For instance, interest expense increased from $121,397 to $144,293 and by $61,810. However, there are also instances of decreased interest expenses, such as a reduction of $4 million due to the final redemption price on securitized debt. Overall, it is clear that the company's debt level and interest expenses have undergone significant changes over the period under review. While some pages indicate an increase in debt level or interest expenses, others show a decrease or no significant change. The financial performance of various regions and segments has been analyzed. Notable performances were observed in the greater than 3-year segment, which includes rate-sensitive assets that generated $8,473,480. Similarly, rate-sensitive liabilities with maturities greater than 3 years also performed well, yielding $6,660,147. On the other hand, some segments struggled. The within 3-month segment, specifically focusing on rate-sensitive liabilities, experienced a significant loss of $5,095,274. This indicates that short-term liabilities were not managed effectively, resulting in substantial financial losses. The management is expressing a cautious yet proactive approach towards the company's outlook and strategy. They aim to maintain a stable financial position by closely monitoring credit losses, managing risk, and minimizing financing risks. The company is focused on generating economic net interest income through hedging strategies and longer-term financing facilities. In terms of investment strategy, the management is positioning the portfolio to maintain flexibility and meet liquidity needs. This includes continuing to borrow funds in the form of secured financing agreements for short-term liquidity needs. Additionally, they aim to pay annual dividends to stockholders of at least 90% of taxable income to maintain REIT qualification. Overall, the company's strategy appears to be centered around risk management and maintaining a stable financial position. By taking proactive steps to mitigate potential interest rate mismatches and managing credit losses, the management is positioning the company for long-term success. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the company has purchased a portfolio of mortgage loans worth $6.5 billion, as well as Home Express Mortgage Corp., for an undisclosed amount in October 2025. Additionally, the company acquired Palisades in December 2024 and purchased $187 million of newly originated non-QM loans and investor loans from Home Express. The company has also made several purchases of securitized debt collateralized by loans held for investment, with a total value of over $1 billion. Furthermore, the company has invested in agency RMBS, although the exact amount is not specified. On the other hand, the company has divested several assets to reduce its exposure and generate cash flow. In 2025, the company sold approximately $608 million worth of legacy loans, as well as $1.2 billion of securitized debt to third parties. The company also exited a short TBA position for a realized gain of $8 million in late March 2026. In terms of specific divestitures, the company terminated an interest rate cap with a notional value of $500 million, resulting in a loss of $4 million. Additionally, the company sold certain loans held for investment and non-agency RMBS assets, resulting in a net realized loss of $40 million. Overall, these acquisitions and divestitures reflect the company's efforts to grow its portfolio while managing risk and generating cash flow. The company's financial records clearly indicate that it has a history of paying dividends to its shareholders. This is evident from multiple sources within the document, including page 7, which states that common dividends paid were $-32,354, indicating a payment was made despite the negative figure being an error in notation. Furthermore, on page 8, it is explicitly stated that the company has paid dividends, with a total amount of $40,974. This confirms the company's commitment to rewarding its shareholders through dividend payments. Additionally, pages 76 and 87 also confirm this information, stating that the company has indeed paid dividends. The latter even provides the specific dividend per share, which was $0.45. These multiple references across different sections of the document leave no doubt about the company's history of paying dividends to its shareholders. That concludes the financial summary for CHIMERA Investment Corporation. Feel free to comment below, and I will be happy to answer them when possible.